Hello, and welcome to the first lesson on international financial management. So we're going to have an overview of what international financial management is. And for the purposes of this session, these will be our learning objectives. So we're going to try to understand what the main goal of a multinational corporation is and the potential conflicts that arise out of that goal. We're also going to try to describe the key theories that justify international business from the perspective of any entity for that matter. Explain the common methods that are used to conduct international business. Go on to identify the opportunities and risk of international business. Now, whenever we talk of a multinational corporation, we are typically trying to refer to a company that engages in any form of international business. So whether they export, import, etc. So typically, in a sense, you can look at it as a firm that engages in some kind of cross-border business. But for the purposes of this class, we'll be limiting our multinational corporation or focusing our attention on a firm that wholly owns a subsidiary, but we'll come to that later. Now, once we have a multinational company, for that matter, an entity that crosses borders as part of its operations, it has to then deal in foreign exchange markets, because what it means is that it will be, for example, if it's exporting, it will be receiving some of its revenue in the form of foreign currency, in which case it would have to convert it into the domestic currency to be able to deploy that kind of money, or that the money in a form that is easily usable. So when we talk of multinational company, we are defining that as firms that engage in some form of international business. So what it means is that their financial management will be considered international financial management. Now, it is important for us to understand international financial management even for companies that have no international business, because we need to recognize how foreign competitors will be influenced by movements in exchange rates, etc., etc. Now, by dealing in multinational business, or in this case, international business, and engaging in the foreign exchange market, it so happens because one, if we happen to be exporting or importing, then we are dealing within the product market, and that import and export will generate payments and receipts, for which reason we would have to convert to the local currency of the headquarters, or should we say the parent company. In the case of subsidiaries, we will be remitting. So remittances that go back to the parent company are likely to be moving from a country that does not use the currency of the parent company back to the parent company's country, and for that matter has to be converted. That also means that that firm or multinational has to go through the foreign exchange market to be able to convert. Then we have the possibility of investing and financing in deploying the international financial market. And of course, by borrowing or investing in that regard, it generates inflows and outflows that are likely to be in foreign exchange, and for that matter would need to be mediated through the foreign exchange markets. So that's the whole idea of the international financial environment. Now, what is the goal of a multinational company? A typical multinational company, like a normal domestic firm, has the goal of maximizing shareholders' wealth. So in reality, for the multinational company, they just have subsidiaries that could look like branches of the headquarters. And then, so the goal here is to maximize shareholder wealth. And so as I indicated earlier, for this course, we'll focus on multinational companies that wholly own their foreign subsidiaries. Now, financial managers throughout the multinational have one single goal. They must maximize the value of the entire multinational company. Now, what conflicts can arise with a multinational's goal? Now, whenever a firm, be it a multinational, even a domestic firm, has managers who are the agents, a conflict of goals or interests can exist. And this is what we call the agency problem. So like a domestic firm, multinational companies also face agency problems, but theirs are typically bigger, and we'll understand why. Now, part of the multinationals agency problem can stem from the fact that subsidiary managers may be tempted to take decisions that can maximize the values of their respective subsidiaries without necessarily focusing on the as I said earlier, agency costs are normally larger for multinationals than for purely domestic firms because normally distance is a problem. It's actually quite difficult for a multinational to monitor distant managers because they are so far off. And so the cost implications, even to fly someone to come and monitor the local subsidiaries' activities, can also be a bit of a deterrent. Also, different cultures can actually cause monitoring or agency costs to go higher. The reason being that in some cultures, things that are acceptable in one, for example, facilitation fees, etc., are a taboo in another, and etc. So depending on where the subsidiary is located, these culture clashes can mean a lot of agency cost and how to go about that. And of course, even for the cultures, you may have agents behaving in manners that are considered normal in their cultures, but actually can bring about not so profitable ventures for the multinational. We also have the issue of the sheer size of the multinational. Usually, larger entities are more difficult to monitor and control, and that also is one of the issues for agency costs as far as multinationals are concerned, and also the complexity of the operations of a multinational. So these are some of the elements that fuel higher agency costs for multinationals. So in a sense, the cost that a firm has to incur to be able to get managers to behave in a manner that is consistent with the desires of the shareholders is what constitutes agency costs. Now, in trying to manage the agency costs, multinationals have options with management styles because the magnitude of the agency costs can actually vary with the management style of the multinational. We have centralized management, which reduces agency costs because then it allows most key decisions or all key financial management decisions, for example, to emanate from the parent company, and the subsidiary is only an implementing body so that the key decisions are taken at the headquarters and cascaded down to the subsidiaries for implementation. On the other hand, a decentralized style or approach to multinational management gives more control to the managers who are closer to the operations and therefore are on the ground and appreciates the environment, in which case then the decision-making of those managers will be more tailored to fit the environment in which they find themselves, as opposed to the centralized management where the decision-making may not be so close or very appreciative of the peculiar environment in which the subsidiary finds itself. And so there could be clashes and more costs as a result of wrong decisions. So there's an attempt sometimes to strike a balance, allow subsidiary managers to make key decisions as would happen in a decentralized setup, but then significant monitoring by the parent company. And in that regard as well, today, electronic networks make it easier for the parents to monitor the actions and performance of foreign subsidiaries. Let's begin to look at what the framework looks like for a centralized multinational setup in terms of the financial management. So as we can see, the financial manager or the financial managers or the parents are the ones responsible for all the financial management functions. So from the capital investment appraisal, the capital structure decision, the working capital and liquidity, etc., everything is coming from the parent. So we have subsidiary B and then we have subsidiary A, and all of them have their matching orders coming from the financial manager at the parent level. And then we have the decentralized, where each subsidiary has the financial management function being managed or being taken over by a financial manager of that subsidiary. In that regard, we can see that financial manager for A will see to the decisions at subsidiary A that could be in another country, and financial manager for B would be in charge of the operations as relates to a second country. And for that matter, what it means is that agency costs could be higher here in terms of the monitoring, but it also means that more often than not, the decisions will be more tailored to the issues that happen on the ground. Now, there is the market for corporate control, which can actually help to reduce agency costs. At least that's the argument. The argument is that if there's a market for corporate control, meaning acquisitions, takeovers, etc., it means that for the corporate control, for example, if a firm is not operating to the best interest of the parent company, another entity could actually take over that subsidiary, buy it off, and then get rid of the management that is not delivering in the best interest of shareholders. So when such a market exists, it's assumed that it also helps to reduce agency costs. The other option would be to provide stock options where managers get options on these stocks to align their interests to improving the stock value or the values of the stocks of the company. So I mentioned earlier the hostile takeover threat. And then we also have investor monitoring, usually from the institutional perspective, where investors get to have caveats clauses and deep monitoring of the subsidiary at that level. Now, we have come to appreciate that the MNC's goal is actually that of maximizing shareholder wealth. Now, what are the kind of constraints that can interfere with those that particular goal of maximizing shareholder wealth? We actually have the issue of environmental constraints. Now, with the environmental constraints, we are looking at the fact that at any point in time, you could have challenges that within the particular environment, whether in terms of the cultural setting, etc., that could be a constraining factor to the achievement of the goal of wealth maximization. Then we also have regulatory constraints. So what could be considered legal, accepted in the parent country could actually be considered inappropriate in another, or the constraints in terms of the flexibility with which some activities could be engaged in. Then, of course, we've talked also about the issue already of ethical constraints, etc. And so, all things being equal, it is known and accepted in literature that investors normally assign a higher value to firms that exhibit high corporate governance standards and obey ethical constraints. So when all is said and done, corporate governance standards also can play a key role in helping to align agency behavior to the desires of shareholders or the principal. Now, given that it appears that there could be gains but also challenges, why do firms pursue international business? In a sense, why do firms cross borders? Now, the basic idea is that by crossing borders or by increasing world production, everyone will benefit through international trade that is achieved first and foremost by one of the theories that justifies international business, the theory of comparative advantage. So if you take any two countries, for example, and they are also producing the same things, there's a high tendency that one country, for example, would be better at producing one item than it is at producing the other, meaning that when you compare these two items that a particular country is producing, they have a better comparative advantage in one, meaning that they are able to produce that more efficiently and they are much better at it in every sense of the word, compared to the second. It could be that on the relative front, they may even be better at producing all those 2 items compared to country K. However, if they had to make a choice between any of the two, there's one in which they are better off, and that we say is their comparative advantage. So for a typical entity that is able to produce that or a typical country that is able to produce at a better price and is more efficient, then that country will specialize in those services and products that they are less inefficient, meaning that they are more efficient at producing than other countries. And so you find that if it's wine, for example, maybe is a Spanish wine, and then maybe when it comes to shoes, we know, let's say Italian shoes. And then when it comes to technology, we can move into the Germany, the Japanese, etc. So each segment has that comparative advantage, meaning that they are able to produce something better than other things. And so they focus and focus their effort on what they are good at. And in that regard, because they can produce that particular commodity or service at a much cheaper rate compared to all others, it means that that service or product will come to the global market at a cheaper rate, which then means that everyone will benefit from a cheaper service as opposed to that particular service being produced by a country that is not so efficient, and so it would come out as costly. Secondly, we have the imperfect market theory. That's another driver of international business. Imperfect market theory. In a perfect market, so we can start from the perfect market perspective, factors of production are mobile, so easily mobile, literally at no cost, meaning that if I want to set up a gold factory, I can set up the factory, let's say in Taiwan, and then come and mine the gold in Ghana and ship to Taiwan to go do my gold accessories and jewelry. But clearly, by the time we may move the gold from Ghana to Taiwan to go do the production of the gold jewelry, the cost of movement, that's the transaction costs of movement, etc., would actually result in it becoming so much more expensive. So it may make more economic sense for this Taiwanese company to come set camp in the location where the gold is and just mine, minimizing cost, etc. And then so factors of production like labor, machinery, etc., cannot easily be transferred between countries, for which reason countries that may want to get into such areas of business may actually have to consider crossing borders into the country that has either the labor or the other factors of production they are looking for so that they can produce. Then we also have the product cycle theory. Now, typically as firms mature or as they grow, it gets to the point where their market may be saturated. So according to this theory, when a firm first becomes established in its home market, it's able to, should I say, make good money on it. But as the product grows, and then to the extent that the firm's product may be perceived by foreign consumers to be superior to that available within their own country, then the original producer may accommodate that international demand by either exporting to that place or even going to set up there and customizing the product to the tastes and preferences of the foreign country. And so we have that product cycle theory. So as firms mature, it may recognize additional opportunities outside its home country. So these are the typical theories that are used to explain international business, or in a sense, used to explain or to justify why firms pursue international business. Now, once firms have decided to pursue or go into business internationally, what are the modes by which they can engage? One of the easiest and the simplest is international trade. That has more to do with exporting. So that's a relatively more conservative approach that firms use to penetrate markets. And so they either export, or in some cases, they can obtain supplies at very low cost. Now, this particular approach entails minimal risk because the firms do not place any of its capital at risk. At any point in time, if they experience a decline in exporting or importing, they can just reduce or discontinue that part of the business, and it's at minimal cost. So exporting and importing is one of the easiest, or should I say the more riskless approaches to getting into international trade. Then comes the aspect of licensing. Licensing here allows a firm to provide its technology to another in another country, for example, in exchange for fees, royalties, or some other benefits. So here, many producers of softwares, etc., actually can license the software to another. And in this case, they receive fees for the use of those softwares, etc. Now, franchising is an extra layer if you want to look at it as if it's almost similar to licensing, except that it comes with clearer and more defined parameters. Because when it comes to franchising, under that arrangement, the parent company or the parent, the franchisor, would actually have all the rights and would give same to an entity to run almost a carbon copy of its business, in which case in some they actually would then invest in the land, the machinery, the buildings, everything, and you work according to the same rules and regulations. So when you crisscross, you might find that, let's say, a McDonald's in China operates almost as exactly as a McDonald's that you find in the US, and yet it is not necessarily owned by it may not necessarily be owned by McDonald's, but rather a franchising agreement. And so in some cases, we refer to this as direct foreign investment. Now, well, for franchising, it can invest in the building, the technology, and then sometimes it will lease these facilities to a franchisee and allow the franchisee to operate the business in the building or for a number of years, etc. But the franchisee in particular must follow the standards set, for example, by McDonald's when operating this business. Another layer that begins to, so you can see that we are moving from degree of involvement and therefore capital being exposed. From the franchising, we can go a step further to actually pursue a joint venture. Of course, this is where two entities come together, or two or more entities come together to operate another venture in maybe a particular country. So most firms actually enter markets by engaging in such joint venture with firms that are already established in these markets, so that it allows the two firms or the three firms to apply the unique competencies that they have or the relative comparative advantages in the given project. So one may bring their technology and another may bring some other expertise, and together they each make the most of it. So you could have an arrangement where maybe one has a distribution chain and one is able to produce, so together they could work out such modalities. Then we also have acquisitions. So you can see we are getting now involved more, where the firm may choose to buy an existing firm to allow it to quickly gain access and control into the market and a bigger market share. And of course, the other one is where they get into the market by establishing completely new foreign subsidiaries. So in general, many multinationals use a combination of such methods to increase international business. Now, what international opportunities are typically available to an MNC? Now, to a large extent, once we have a multinational, and of course, if you want to even stretch the term, a multinational means multiple nations, sort of. It means that it has better investment opportunities because, to a large extent, the marginal returns of multinational projects are above those of purely domestic firms. And then for multinationals, meaning that they have an expanded opportunity set for possible projects, because then with the horizon they are looking at, they are not just stuck in the one domestic market, but they can combine in many forms opportunities arising from their domestic market and other opportunities arising from the external market. When it comes to financing opportunities, MMCs have the potential to be able to raise funding at lower cost due to their larger opportunity sets of funding sources. So, for example, if we have a firm headquartered in Dubai and in Ghana, funding costs maybe in Dubai may be cheaper, even though the currency may be almost at par, for which reason then it may make more economic sense to raise the money from the parent company, lend it to the subsidiary at a cheaper rate, which then means that with this lower cost of capital for the subsidiary, they have options in terms of being able to undertake better projects, or should I say, having an expanded pool of projects to pick from, and for that matter, make better returns compared to a purely domestic firm, let's say resident in Ghana, that has no choice but to raise the capital in Ghana, in which case the higher cost of capital that they're exposed to means that they can only look for projects with higher rates of return. So these are some of the opportunities that are available for multinationals. But clearly, with opportunities come the issue of risk. And one of the key ones that international business exposes MNCs to is the exchange rate movements. At any point in time, currency movements between the parent company and the subsidiary home economy could hold significant implications for either making a profit or making a loss. And then also the issue of what happens within the foreign economy, because to a large extent, demand is driven by the state of the economy. When an economy is doing well, there's likely to be higher demand for whatever goods and services a multinational may be providing in that market. So when there's a drop in demand, chances are high that demand will also, that demand will affect the prospects of a multinational that is operating within that local economy. Then there's also the issue of political risk, which means that at any time where there are upheavals, that could negatively affect that multinational through its subsidiary located in that host economy. So these are some of the basic elements that you need to know, at least in terms of multinational companies and how the overview in terms of how multinationals operate, the risk they're exposed to, the opportunities that come their way. To a large extent, you need to understand why agency costs may be larger for multinationals than for a purely domestic firm. Why would a firm choose to expand internationally? What are the risks they face? And of course, why must purely domestic firms be concerned about the international environment? What factors can cause some firms to become more internationalized than others? And of course, it's important to also understand and maybe offer an opinion on why the internet may result in more international business. And of course, you need to be able to read scenarios and offer intelligent, should I say, recommendations and strategies. And so knowing the various forms or modes by which a firm may pursue international business, and also to understand the role of ethics and other governance issues as far as international business is concerned. So to a large extent, that brings us to the end of lesson 1. We'll meet for lesson 2. Thank you.